Here is what most new authority carriers get wrong about insurance. They treat the year one bind like a commodity purchase. 3 quotes. Pick the cheapest, sign, move on. Then they spend the next 2 years discovering that the choices they breezed past in week 1 are quietly governing their entire operation. The truth is, year 1 insurance is not a transaction. It is the foundation of a multi-year underwriting relationship that determines what loads you can book, what brokers will work with you, and what your renewal looks like when the new authority surcharge finally comes off in month 13. Dispatchers and owner-operators often think the decision is just about price. It is actually about 5 connected choices that interact with each other: coverage level, physical damage scope, deductible structure, payment structure, and broker selection. The cheapest quote at bind almost never produces the cheapest total cost of risk over 24 months, because the variables that move premium down in month 1 are usually the same variables that leave you exposed in month 4. Get the framework right at the start, and you save yourself $1,000 to $3,000 a year for the rest of your operating life. Here is the failure mode I see most often. A new MC takes the lowest quote on the table. It is $12,000 annual, financed at 25% down, with a $5,000 physical damage deductible, because that is what got the premium to 12. They feel good about the win. Then in month 4, a parking lot incident damages the tractor. $3,000 in repairs. The deductible is $5,000, so the carrier eats the entire repair out of pocket. They do not have $5,000 in cash because they financed the premium specifically to conserve cash. Now they are running on credit cards, and the broker who placed them in a new business appetite underwriter calls in month 11 to say the carrier is non-renewing this class of business. Renewal shopping starts from scratch with a fresh round of MVR pulls, a fresh round of underwriting questions, and a market that has already moved. The cheap quote cost them about $4,000 in cash drag, 2 weeks of dispatcher time at renewal, and a relationship reset they did not budget for. None of that shows up in the original quote comparison. Here is the right approach. Start with $1 million in auto liability and $100,000 in cargo as your floor for general freight. That is the de facto industry standard, and dropping below it locks you out of most broker setups. Ask 3 trucking specialty brokers what the jump to $2 million auto costs, holding everything else constant. If the bump is 10 to 15%, take it. If it is 30 plus, stay at $1 million for year 1. On physical damage, carry it on the tractor without question. On the trailer, do the math. Premium runs about 3 to 6% of trailer value annually, so a $30,000 trailer costs you $900 to $1,800 a year to protect. For deductibles, the sweet spot for most new carriers is $1,000 to $2,500 on physical damage. Going higher saves you about $200 to $400 annually, but adds $1,500 to $3,500 of at-risk exposure you may not have the cash to absorb. On payment structure, finance over 9 months with 20 to 25% down, unless paying in full leaves you with at least 6 months of operating cash in reserve. The finance charge is a few $100s, real but not punishing, and the cash conservation is almost always worth more in year 1. And on broker selection, filter for trucking specialty. Ask directly what percentage of their book is trucking and whether they write new authority regularly. Independent multi-carrier brokers beat single-carrier shops almost every time because they can shop your file across appetites. This is where Cypress fits into the picture. We are not in the insurance brokerage business. We do not place auto liability or cargo. What we do is run the compliance infrastructure that sits underneath the insurance relationship and quietly determines what your underwriter sees when they evaluate you. Your CSA score is a direct underwriting input. Your MVR record on every driver is a direct underwriting input. Your IRP registration status, your IFTA filings, your 2290 stamp, your MCS 150 biennial update, your BOC3 on file, your UCR current. All of it shows up in the underwriter's pre-bind review and again at every renewal. Cypress runs all of that directly against the federal and state portals on your behalf. We pull MVRs annually under DPPA permissible purpose. We monitor your CSA basic scores against the FMCSA public data feed and alert you when you cross intervention thresholds. We file your IRP renewal and your quarterly IFTA returns. We e-file your 2290 directly to the IRS. And we keep your MCS 150 and BOC3 current, so a stale filing never triggers a coverage question at renewal. The compounding effect over 2 and 3 years is that your insurance shopper walks into renewal with a clean compliance file, and your underwriter has nothing to flag. That is what produces the 10 to 20% renewal reduction you actually want. So here is the single action. Before you bind year 1 insurance, get 3 quotes from trucking specialty brokers, not general commercial agents, and ask each one the same 5 questions on the same coverage spec. 1 million auto liability, 100,000 cargo, physical damage on the tractor at 1,000 deductible, 2,500 deductible alternate, and 9-month finance terms. Then ask each broker what percentage of their book is trucking, whether they place with multiple underwriters, who handles claims, and what a typical year 2 renewal looks like for the underwriter they are placing you with. Compare the 3 on total package, not on headline premium. Pick the one whose answers tell you they will still be useful to you in month 13 when renewal comes around. That decision, made deliberately in week 1, is worth $2,000 to $4,000 a year over the life of your operation, and it costs you exactly 30 minutes of effort on the front end. Do that, and the rest of your compliance stack becomes a system to maintain, rather than a fire to fight.